and foremost, what is a GP stake? A GP stake involves the purchase of a minority passive interest in a private equity firm, allowing investors to sit shoulder to shoulder with the owners and access the long-term success and growth of the asset management firm itself. So why have we been very large investors in GP stakes? We're actually one of the largest in the world, and we get to own some of the most profitable asset management businesses, also known as general partners. Here, from this point on, we're going to talk about them as GP. So GP stands for general partners. The reason why we've invested so much in the GP stake universe is because of a couple of reasons. The first is the ability to generate significant cash flows, as well as have high growth opportunity from businesses that are already doing very, very well. We don't have to wait and figure out who's going to win. We already know who's winning, and we want to be able to take advantage of their success now as well as what they do in the future. It's a rare combination that we see in this area of significant upside optionality with very strong downside protection. And it's a very unique ability that we have to own some of the most profitable businesses in all of finance. And there's just not much that we see in the investment universe today that gives us the same kind of cash flow, growth of that cash flow, and optionality for outsized returns than what GP stakes will provide for us. So let's talk about the markets themselves and the growth of private markets. Why are they growing? The first is performance. It's really irrefutable that people are going to go where strong returns are. And the private markets have performed extremely well compared to the public markets over long periods of time. Just to be sure we're definitionally in the same place. A private market is something that doesn't trade every day. There's not a listed market for it. The public markets would be where there is a publicly traded security that you can buy and sell on a regular basis, a daily basis, or even, monthly or weekly or quarterly. So that's the public markets. Private markets have dramatically outperformed over time. And when you start thinking about compounding money at a dramatically higher rate for periods like 25 to 30 years, the amount of wealth creation is just enormous. And so that is increasing the demand for private investments from institutions, family offices, high net worth investors. They are seeking out the best returns, and they're doing so in a largely increasing magnitude. When you look at the history of private equity compared to public equity over the last 35 years, private equity has actually outperformed the public markets in 35 of the last 35 years. So not only is there dramatic outperformance, but there's also been more consistency of outperformance in the private markets, which leads to significant amounts of growth. What this chart shows is how over time, there's been so much growth in the private markets. And this growth is expected to continue with more than a doubling in private market assets under management over the next 5 years. So when we look at the allocation that's flowing into the market because of just strong performance and people, seeking out that strong performance, what we also want to look at is a mechanical issue that is causing institutions to increase their rate of deployment. So what this chart shows is it shows where institutions want to be. Their target asset allocations to private markets, they're not where they want to be. And so as a result, they need to increase their deployment. They need to increase the rate at which they're making these investments, which causes more money to flow into the space. Further, in addition to their current exposures not being enough, institutional investors overwhelmingly plan to increase their target allocations to all categories by 2025. So when we look at this chart, what it shows is that the overwhelming majority, 90% plus in most cases, they not only are planning to increase their allocations or at least keep them the same, but in many cases, as we saw on the previous slide, they're already underallocated. So the catch-up effect is very real, and we expect that to continue. So that trend is very easy to spot. But how does somebody make money from that? How does someone actually make a profit from this trend that you recognize and that we recognize? Well, first, we feel like you need to find a way to own a stake of some of the very best in the private markets and to benefit from that inflow of money that is coming into those managers to manage on behalf of institutional investors. So you get, as a result of that, you should be able to benefit from high cash flow distributions that these businesses provide to their owners. You can also expect an increasing cash flow stream as the firms grow their asset base. From there, you can create capital gains from the increase in the value that obviously, if they're growing their businesses should be worth more in value. So why would somebody want to own these businesses? There's a lot of very attractive attributes, and kind of number one is profitability. These are some of the most profitable businesses on the planet. Part of the reason for that is they have very attractive management fees that they charge their investors. Their investors are typically large institutions. So think sovereign wealth funds, state pension plans, foundations, endowments, family offices, etc. And these general partners will manage the money for their limited partners and charge them a fee for doing that. And because what they're doing is more complicated than just buying IBM or buying Apple, there's a higher management fee attributed to that skill set that is required. Typically, that's 1.25% to 2% per year. That result is very strong operating margins. So just from management fees alone, most of these businesses generate 60% or higher operating margins, and they have very low fixed expenses. Well, why is that? It's easy for everybody to understand. If you have $1 billion fund and you have a certain number of people to manage that $1 billion fund, you might need a few more people to manage a $2 billion fund, but you don't need twice as many people. So there's tremendous operating leverage that comes as a result of that, because most of the expense is people expense, which means their operating margins don't have to be burdened by very large cost of goods or factories or equipment, or even that much rent for, as an example. So because of that, we not only see high operating margins, but we also have a lot of upside optionality, because the carried interest, the percentage of the profits, carried interest, percentage of the profits, same thing. The percentage of the profits that they earn is directly attributable to the size of the profits they create, but also the size of their funds. So a really simple example, if you have $1 billion fund and you generate a 2% management fee, that's $20 million in annual revenue. And you manage your business with maybe $8 million of expenses. Well, now you have $12 million of profit. But it doesn't stop there. You actually get, in most cases, 20% of the profits. So if you're able to turn that $1 billion into $2 billion, you make an extra $200 million off of that $1 billion portfolio. And obviously, if you, on your next fund, raise a $2 billion fund, now you have $40 million of annual revenue from management fees alone. And if you double that $2 billion to $4 billion, now you have $2 billion of profits. You get 20% of that. That's $400 million. So it's easy to understand where the profitability comes from in these businesses. And as you can see in the chart, there's no sector that's even close to the operating margin of a private asset manager. So when you look at the opportunity as an owner, you get the ability to get the economies of scale and the ability to get that optionality that comes from doing a very good job. And as an owner of these businesses, you get to share in all of that shoulder to shoulder, like we'll talk about here in a couple of minutes. Additional attractive attributes is stability. So what a lot of people don't know is when someone invests, so let's just use Texas Teachers Retirement System. When they invest in a private equity fund, that revenue for the manager of that fund is typically 10 years or longer in duration. If you think back to my example just a second ago, you talk about $1 billion fund generating $20 million in revenue. It's really easy to budget if you know exactly what your revenue is going to be every year for the next 5 years. So you can lock in your operating margin with very small variability. So the recurring revenue business model that these firms have is tremendous because these fees are contractually obligated. These contractually obligated management fees are not negotiable. It's in the contract. They have to be paid, no matter what, to the manager of these funds, which makes it very attractive from a stability standpoint, and it gives us a tremendous amount of safety. We also know that we are investing in established managers. These are not people we hope are going to be successful. These are people that are already successful. They've proven with their track record, and they have a very high quality institutional investor base that they're really good at what they do, and we get to participate day one right alongside of them. We also get vintage diversification across multiple active funds. There are some firms that do one thing and they only have one fund, but most firms have multiple active funds, maybe over different cycles or of different vintages, or maybe even different styles, as we'll talk about in a few minutes. The other thing that we get is growth. We've already talked about it a little bit, but the amount of asset growth has been 13% plus compounded annually from 2005 to 2021, and is expected to continue to grow because of the things we talked about. 85% of investors are expected to increase or maintain their exposure to private markets. So we are expecting even faster growth over the next 5 to 10 years as these institutions play catch up and as more and more new investors come into the private markets. So cross-cycle diversification, it sounds like a mouthful, and it really is. Cross-cycle diversification is one of the things that we find to be the most attractive to owning private asset management general partners. What is cross-cycle diversification? Well, I'm going to use a wine example because vintage years, most people think of wine. If you own a 2015 Bordeaux, you own that particular vintage, and it might be a really good year. It might not be a great year compared to the 2016, 17, 18. So that is what we mean when we say vintage years. So if you think about owning a private asset manager, if you're going to get the benefit of what they do now, what they have in the ground, and what you're going to be able to participate in the future, you get a lot of diversification cross-cycle. One other example. In any fund, if you invest and you happen to invest in something that might be really affected by the economic cycle, if you invest at the right time, it can be massively successful. But as everybody knows, you might invest at the wrong time, which means you might invest at the exact worst possible time in the cycle. Naturally, if you can diversify across vintages, it's better because then you have that diversification across the economic cycle. So how does that work in practice? So in this very simple hypothetical example, we show the economic cycle, booms and busts, recessions and expansions. And so if you have in this illustration a couple of different managers, and you own multiple firms that launch at a really good time, at a medium time, at not a good time, at maybe an okay time, and then a better time, and then the perfect time, and then maybe an okay time, etc., you don't have to worry as much about the economic cycle. Hear that again. If you invest in the GP stake landscape in a diversified way, the cross-cycle nature of these businesses makes the recession risk or expansion risk less of an issue. Just the normal economic cycle becomes much less important than if you're just going to pick a fund or pick a particular manager. Remember that. It's going to become very important here in just a few minutes. So a lot of people also don't realize what these operating margins and this upside optionality, become. And so what industry has created more billionaires than any other? According to Forbes, more billionaires have been created by finance and investments than any other industry. This is a very profitable business line. Thereby, we like to own these very profitable businesses and make money the way that they do. So what exactly is a GP stake? Well, it's going to get a little bit technical here, so bear with me. But when we own a stake of a firm, we're going to be able to go shoulder to shoulder with the management team, with the people that are actually making the decisions day to day and managing that business. To be clear, you don't want to invest unless you're shoulder to shoulder with the management team. You want to be aligned as much as you possibly can be, because that is where good decisions are made. Misalignment leads to bad decisions. Alignment leads to good decisions. So when we own a stake in these firms, we expect cash flow and returns from 3 different sources. Management fees, already talked about that, usually locked in for at least 5 years, usually 10 years or longer, paid on a fixed schedule. And these are large institutional investors that are investing this capital in these general partners. Carried interest, that's a lot less predictable. It's based on performance. We talk about this a lot. You basically have the farmer analogy. You plant the field, you cultivate the field, you harvest the field. Well, you think about the typical farmer. The whole time that they're planting and cultivating, they're just waiting to get paid at harvest time. That's not the way it works in private assets. Because when somebody is planting the field, they're getting paid a management fee while they're planting. When they're cultivating, they're getting paid a management fee while they're cultivating. And when they're harvesting, yes, they're still getting the management fee, but now they're also benefiting from the harvest and the carried interest, the share of the profits. So it's certainly lumpy, but it's also where all the upside optionality comes in, because the better the fund performance, the better performance for you as an owner of that business. So one of the most common questions we get, candidly was the question I asked first, is if these are such good businesses, why would somebody want to sell a stake in it? Well, first of all, let's make sure we define what a stake is. In most of these situations, we're buying 5% up to maybe 30% of these companies. So they still own, the owners of those businesses still own 70, 80, 95% of their businesses. If somebody is just looking to go to the beach and take a bunch of money off, that's of no interest to us. That's a hard pass very, very easily. So there's got to be a very good reason why somebody would want to sell a stake. And clearly, we want to make sure that stake is fairly valued. But the more strategic, the more it makes sense of why they want to sell a stake, the more we obviously can get comfortable with how we're going to be aligned with these owners to be able to allow 1 + 1 to equal a lot more than 2. So let's talk about some of the economic motivations. It could be simply because they're growing so fast. You know, my example earlier, you have a $1 billion fund, you put up $20 million. Well, then you go raise a $3 billion fund. Now you got to put up $60 million. Then you raise a $5 billion fund and you got to put up, in that situation, $100 million, but you haven't gotten your first $20 million or $60 million back. So you get money that goes on your balance sheet that allows you to be able to raise bigger and bigger funds, because that's very profitable for everybody that's involved. There also could be reasons to launch new products or to go into new platforms, maybe to expand to Europe or to launch a credit business, those kinds of things. But there needs to be a strong economic motivation and it usually is and, not or, a strategic motivation. Maybe it's capital solutions that they need. Maybe they want to launch an M&A or a mergers and acquisitions program. Maybe they need some guidance as they hit the next plateau in their business and they want somebody to be in the boardroom with them, helping them with those decisions. Maybe it's because they need distribution in a particular market. Maybe they're really strong in North America, but they don't have any exposure in Europe. Or maybe they're really strong in Europe and they don't have any exposure in Asia, and they want to get a bigger platform. So no matter what, we will not invest in a stake in a business unless there is a very good reason of why that makes sense and why that will end up with, hopefully, 1 + 1 equaling a lot more than 2. The other thing we love about the GP stake space is it fits so much the way we think. As a firm, the first, second, and third question in an investment committee meeting every single time is, what's the worst case scenario? How can this go wrong? What can blow up in our face? What is it that we just don't expect that could really hurt us? That worst case scenario, we really hone in on. And we know that if we can live with the worst case scenario, the upside will absolutely take care of itself. GP stakes can provide some of the best absolute protections in all of the investment universe. And it primarily comes from those contractually obligated management fees. They don't have to grow, they don't have to expand, they don't have to make money for people. Just from the management fees alone, in most cases, we feel like we're going to get almost all, if not all, of our money back. So additionally, the performance fees and the growth of the business itself, that's all just upside. So if we can live with the worst case, the upside will take care of itself.